in the spirit of our reflect theme, I'm going to take you back in time, way back. I want you to imagine that it's 100 years ago, 1924. There's no Wi-Fi, there's no smartphones, and the only cloud you're thinking about is the one in the sky. Now, in this scenario, you're a Black man living on the south side of Chicago, and you're trying to buy a home for your family to live in. Except you can't, because no bank will give you a loan. This practice, which we all know is called redlining, is just one part of banking's legacy of inequality. Now imagine it's 50 years ago, 1974 this time. You're a white woman walking into your local branch to open an account. Except you can't, because you're not married and you don't have a male cosigner. It's months before the Equal Credit Opportunity Act will outlaw discrimination on the basis of gender and marital status. And if you happen to be a Black woman like me, you still got several years to wait before ECOA is amended to include prohibiting discrimination on the basis of race and other factors. Powered by discrimination, practices and policies, whether formally institutionalized or not, limited access to credit, limited business ownership, and they limited many other economic resources. But you might be thinking, that was decades ago. Surely things are better now, right? Yeah, I see a few head nods in the yes-no direction. I'm gonna go with yes and no, actually, as my answer to that question. Yes, it is definitely true that by and large, discriminatory policies have been eliminated from the industry. However, lots of studies show that for women and people of color, on average, they have lower levels of savings, lower home ownership rates, and are generally more financially vulnerable. The aftershocks of past discriminatory practices can be felt today, and they persist in long-term disparities in wealth. Candidly, I'm telling you a story that many of you know. Part of why we're all in this room is because we're deeply invested in changing the trajectory that we're on, myself very much included. And I'm gonna talk about how technology, and AI in particular, can help level the playing field by increasing access to financial resources and tools. I know it sounds a little lofty, but bear with me for a second. We've already seen plenty of evidence of technology increasing access. Take mobile banking as an example. Users can access almost any financial tool, pay their bills, deposit their funds, from wherever they are, whenever they are, no need to walk into a physical location. In fact, I think mobile banking has likely contributed to the dramatic reduction we've seen in the underbanked rate in this country. According to the FDIC, the use of mobile banking reached 43% of the US population in 2021, and in that same year, the underbanked rate fell to its lowest level ever of 4%. Take another example, like P2P. Peer-to-peer payment services like PayPal or Cash App, or you pick your favorite one, all enable users to send and receive money without even needing a traditional bank account. So while cloud computing and machine learning have unlocked the advances I just talked about and so many more, generative AI can enable a whole new class of tools that improve access. Now, I'm only with you for a few minutes today, so I'm gonna give you just one example. Imagine a co-pilot. I know the word co-pilot is thrown around a lot in the generative AI context. In this case, think of your financial co-pilot as a bit of an advisor. It understands your specific history, it understands your goals, and it's equipped to give you tools and advice in the right moment, in the right way, to help you build your financial security and over time, build wealth. Generative AI makes this possible in a few ways. First, conversational AI makes it seamless and easy to interact with this financial co-pilot, and maybe more importantly, makes it way more feasible to deliver that kind of service at scale. And because Gen AI operates in so many different modes, text, images, video, these tools can be customized to deliver the right educational tip at the right moment in your experience in the format that best works for you to help you learn and help you make a better decision. Now, third, maybe most importantly, but surely the one I'm most geeked out about, is that the same frameworks that power large learning models, LLMs, the same frameworks that harness all the written data you need to power an LLM, you can turn them around on different kinds of diverse data. Data about you, like your banking transactions, your credit transactions, and what you're doing on P2P, and data about millions of people like you. These LLMs can be developed to harness this diverse data and create next best action models, essentially the thing that will power what is the right financial tip or the right financial action for you to take in a personalized way. Now, I know I got a couple of fellow model geeks out here. I self-assess, I am a model geek. We all know that pre-LLMs, this kind of capability simply wasn't possible. We didn't have the compute power nor the modeling tools to harness this level of data to develop the kind of recommendation engine that we're talking about. But now the idea of a next best financial action model, it's absolutely within reach. Now, I have a little bit of worry that you'll take my enthusiasm for the possibilities of what generative AI can do and think that I'm a bit naive, but I'm not. I don't naively believe that just left to its own devices, these tools and technologies will naturally serve the customers and the users that we all care about. In fact, I think we'll have to focus on several key steps in order to ensure that the financially underserved benefit from the emergence of these tools. So let's talk about what some of those things might be. I'm going to touch on just 3 today. As we build these models, we must train them on data that includes the users we care about. Lower income consumers, paycheck to paycheck consumers, and not just on the margins of our data. They have to be in the central parts of the training database. Second, these models are complex, and the risk of inaccurate outcomes or hallucinations, as we often talk about them, is real. We need safe ways to test and time to refine these models in order to increase the accuracy levels. In my opinion, they are not ready today, but I think it's a matter of testing and time before they absolutely will be. And thirdly, we need comprehensive frameworks to assess the effectiveness of these tools across income bands, across demographics, and more. If we create a financial co-pilot who largely delivers get this loan for Black users like me, and largely delivers get this high yield savings account for white users. Yeah, exactly. We will have failed. In fact, fairness is so important. I'm going to spend just another moment here. In the context of financial outcomes for consumers, we actually already have practices for reducing bias in lending models and holding companies accountable for creating unbiased outcomes. I believe we can use those same frameworks and adapt them rather than throwing them out and starting from scratch with brand new rules for Gen AI. For example, today's first-line model builders have developed a lot of good practices and are pretty diligent about avoiding high bias features or seeking out data with less correlation to demographic factors. How do we apply that same sort of approach to the data that we use for generative AI financial models? Similarly, when we think about our second-line teams and our regulators, goodness knows they are already evaluating model outputs for unusual sloping along demographic lines. How do we think about the use cases where generative AI models will actually produce customer outcomes and apply those same frameworks, adapted surely, but evolve and adapt those frameworks so that we can bring that risk experience that we have and apply it to this new space? We need to leverage those frameworks and really apply them to these new recommendation engines. So, while I believe that there is a ton of possibility, I also believe that there are some critical things we will need to do together in order to ensure that that vision comes to life for financially underserved customers in the way that we want it to. I started this conversation by asking you to imagine that it was 100 years ago. I hope I've shown how technology has played a critical role in improving financial health for that family on the south side of Chicago. Maybe more importantly, I hope I inspired you with a bit of what the possibilities are for how generative AI can be used to advance this agenda that we all care so much about. But if I leave you with just two things from our conversation, I hope you take away that one, it's critically important that we bring to life the data that's needed, the diverse data that covers the users we care about, into the training of these new models and new tools. And second, bless you, we have to help our industry to evolve the frameworks for fairness and model outcomes. Let's wrap by envisioning 10 years from now. It's the 30th annual Emerge conference, and we're all back here together talking about and celebrating the millions of people who now have access to better financial tools and healthier financial lives. Thank you.